So how do you start investing in stocks? You'll be surprised that the first thing I tell you is don't buy a single stock, at least not yet, especially if you're a beginner. What I'm about to tell you in this video will either set you up to grow real wealth over time or quietly cost you thousands without you even realizing it. But hey, I'm not a financial advisor or an expert. This video is not financial advice. I'm just a regular investor sharing what I've learned. When I mention specific investments, those are either examples or what I personally do, and what works best for me might not be the right fit for you. Please carefully consider your own goals and situation and talk to a financial advisor if you need financial advice. Okay, now let's go through the 7 things you need to know as a beginner before investing into the stock market if you're serious about growing your wealth. And stick around for number 4, especially because most people skip this and it's something many people end up regretting. The first thing is something most beginners completely overlook, but could mean the difference between losing all of your money and long-term growth. And that is the decision of investing directly in individual stocks and investing in stocks via index ETFs. While many people think about picking winning stocks, what usually happens is the opposite. Buying shares of only one or a few specific companies only means that your financial success depends entirely on their specific performance, exposing you to massive potential losses if they fail. But there's another way to grow your wealth. You can invest into stocks indirectly via an index ETF. An index ETF tracks a market index, for example, the S&P 500 or the S&P TSX Composite. It doesn't actively pick stocks, and that's why it's often called passive investing. And by investing into an index ETF that holds hundreds of different stocks, you are automatically diversified into hundreds of different companies. Instead of betting on one company doing well, you're betting that the overall market will be higher in the future. 2 examples of ETFs that track the S&P 500 are the VFV or the VOO. Note that even though you invest in an index ETF, there is no guarantee for how much and how fast your money will grow. It just means that you are diversifying your investments by not putting all your eggs in one basket. Also important to know is that index ETFs are different from mutual funds. Both give you diversification. The key difference though is that most mutual funds are actively managed, meaning a professional fund manager is picking stocks instead of just tracking a whole market. A Canadian report found that over 10 years, up to 95% of actively managed Canadian equity funds actually underperformed their benchmark index. Now think about this. These are professional fund managers with full research teams. If even they can't consistently beat a passive index over the long run, the odds really aren't that great for the rest of us picking stocks on the side. Now, if you want to learn more about index ETFs, you can watch this video later. The second thing you need to know before you start investing into the stock market is something many people are not really aware of, but can quietly reduce your investment gains. And that is the cost of investing. And here are some of the costs that are involved in investing. First, the MER, or Management Expense Ratio, an annual fee built directly into the fund. In Canada, the average MER for equity mutual funds sits around 2 to 3%. For index ETFs, it's typically closer to 0.2%. That difference might sound small, but it compounds a lot. On $100,000 starting investment, choosing a 0.2% ETF over a 2% mutual fund could save you roughly $80,000 in fees over 25 years on identical returns. Another cost is fees. If you're investing through your bank's advisor or traditional firm, there's often an additional advisory fee, often between 1 to 2% each year, or sometimes even more. On a $100,000 portfolio, that's at least $10,000 to $20,000 over 10 years. Luckily, nowadays there are ways to invest completely on your own via self-directed trading where no additional fees apply. Self-directed investing basically means that you make your own decisions about your investment account, which stocks or ETFs exactly you want to buy, when and how much you want to buy and sell. You manage it yourself, so there is no advisory fee on top. Another cost to investing are monthly fees to maintain your investment account and trading commissions, which is the fee charged to you on some platforms every time you buy or sell. Now, the thing is that while many traditional banks still charge trading fees, most online investment brokers and platforms in Canada nowadays have brought this amount completely down to zero. Now, I invest on several platforms, but one of the investment platforms I have been using for over 5 years since I first started investing in Canada and still enjoy using the most is Wealthsimple. I opened a self-directed investment account on Wealthsimple that let me manage my own investments without a monthly fee, without trading fees for buying and selling stocks and ETFs. Wealthsimple is genuinely beginner friendly and everything is in one place. You can open a TFSA, RSP, and other registered accounts, cash accounts, USD accounts, even crypto. This is awesome considering that many traditional bank brokerages often charge a ridiculous $5 to $10 per trade and are pretty clunky by comparison. Full disclosure, I am not sponsored by Wealthsimple, but I do have an affiliate link down below and you can get a $25 bonus if you use it to open an account and fund it. I may earn a small commission if you sign up through it at no additional cost to you. Now here's the third thing that trips up a lot of people right at the start of their investment journey, and that is the difference between long-term investing and day trading, and they're not the same game. Day trading means watching charts, catching price movements, getting in and out of the market fast, trying to cash in profits. And it looks exciting. The data on it, though, is pretty sobering. Studies across multiple markets show that about 72 to 80% of day traders lose money. Only about 5% are consistently profitable after fees over a multi-year period. It's sobering to realize that the vast majority of active traders underperform less active traders. The results are stacked against you. And besides, day trading isn't passive. It's much closer to a second full-time job. It requires constant monitoring, emotional discipline under pressure, years of learning technical analysis. It's just not realistic for most people, especially not beginners. Long-term investing is a completely different mindset. You buy, hold, and just let time do the work. Markets move sharply in the short term, and that's normal. But the long-term direction, and by long-term I mean a decade or a few decades, has historically been upward. The S&P 500 has averaged roughly 8 to 10% per year over the long run. Here's the deal, guys. It's not about finding the perfect moment to get into the market, but it's much more about staying invested long enough for compounding to take over. Now, the next thing to know is something that many beginners get stuck on. It's the paralyzing question of, when do I actually start? Say you have $10,000. Should you invest everything now or spread it out over time? And this is where we talk about timing the market versus just starting. And there's a lot of debate on this. Now, here's some nuance. If you already have a lump sum available, a bonus, savings you've built up, an inheritance or so, research actually leans towards investing it all at once. Not financial advice, guys, just sharing based on my research. A Vanguard study covering 1926 to 2015 found lump sum investing, or investing everything at once, outperformed a phased approach roughly 2/3 of the time, because markets trend upward over the long term and time in the market beats time spent out of it. But as you see, it's 2/3 of the time, meaning there's still no certainty because it really depends on when you enter the market and when you get out of it, if you do. But if going all in at once feels too uncomfortable, then spreading out your money across 3 or 4 tranches over a few weeks or months can be reasonable. The other question is whether it's better to invest as soon as you have the money, or save up a more substantial amount and then invest everything at once in the future. To this, the research points more towards invest as you go. Waiting for the right entry point is market timing, and it tends to backfire. Missing just the 10 best trading days over a 20-year period drops your annualized return from 9.2% down to just 5.6%. Those 10 days are just impossible to predict in advance. Investing regularly, or dollar cost averaging as you earn money to invest, removes that temptation to time the market entirely. So personally, this is what I would do. If I had a lump sum of $10,000 to $100,000 sitting around, I'd invest it earlier rather than later. And the larger the amount, the more I'd lean towards splitting it up into just a few chunks and investing it soon over a few weeks or months at the most. But looking forward, I try to invest regularly as my money comes in, rather than waiting to accumulate a large amount to then invest it all at once, trying to time the market. Now, whatever you do, waiting too long to invest into the stock market can cost you real money. Again, there are no guarantees for growth, but over long periods of time, your money can seriously compound. So to help you visualize how significantly your investments could grow based on different rates of return, I've put together a compounding growth chart, and it's totally free for you if you sign up to my newsletter. And don't worry, I'll not bombard you with a daily or even weekly emails. I'll just send you an email once or twice a month at the most if I have something useful to share about growing wealth. Now, for example, if we'd assume an 8% average compounding rate and invest invested $1,000 each month, we'd be at about $183,000 in 10 years and $589,000 in 20 years. Just click on the link below to sign up and I'll email you the free compounding chart right away. Now, the fifth thing you need to know to invest into the stock market is one that catches a lot of people off guard, not because they don't know markets go up and down, but because they don't realize how far they can actually go. It's about risk and volatility. The market will drop at some time, that's a certainty. The risk is just not being prepared for it. Similar to the S&P 500, the S&P TSX Composite, which tracks many of the largest publicly traded companies in Canada, dropped roughly 37% during the COVID crash from February 19th to March 23rd, 2020. If you were invested during that time and sold out of panic, you would have made a huge loss. Consider though that if we zoom out, this is just a little blip in history as it's gone up ever since. Even a diversified all-equity ETF like VEQT or XEQT that are diversified internationally can lose 30 to 40% or more in its value in a significant downturn. That's not unusual, that's just how markets work. The issue isn't the job itself, but it's whether you are positioned to wait for the recovery. Now here's an important rule. Don't invest money you will need within the next 3 to 5 years. Seriously, don't invest money into the stock market that you'll need for your daily expenses, tuition, a near-term home down payment, or even worse, medical expenses. That money belongs into a lower risk asset, something like a high interest savings account. Only money you can genuinely leave untouched for the medium to long term should go into stocks or ETFs. And for security, also make sure that you always have an emergency fund put aside, so you're never forced to sell any of your investments when they're at a low. And here's another thing where I really value security. I'm going to go traveling again soon, guys. I think to South Korea again this time. Last time I only made it to Myeongdong, this time hopefully to Gangnam as well. And as always, when I'm traveling, I make sure that I never use public Wi-Fi when I'm checking my investment accounts. Instead, when I'm traveling abroad, I use an eSIM like Maya Mobile, so I always have my own data connection at a really affordable rate without paying crazy roaming fees. For extra security, I also like to use a VPN like NordVPN when I'm logging into my accounts. I also have some affiliate links in the descriptions below that can give you a discount in case you want to sign up with either of them. Again, I'm not sponsored by either of these companies, but these are affiliate links, so I may earn a small commission in case you use them at no additional cost to you. Now, the sixth thing you need to know before you invest into the stock market is something that a lot of beginners don't know about but can make a real difference. Here's the thing, guys. When you go to buy a popular ETF, you'll often find it listed in two versions, Canadian dollars or US dollars. For example, the VOO is the US dollar listed Vanguard S&P 500 ETF. VFV is essentially the same fund, just listed in Canadian dollars. Same underlying holdings, different currency. Buying the VOO, so the US dollar version, means that you have to first convert Canadian dollars into US dollars. Your broker applies a currency spread, and then there's usually a foreign currency conversion fee. That's usually around 1.5% for most financial institutions. You can lower your costs a bit if you use Norbert's Gambit and transact in large amounts. When you buy the Canadian version, the VFV, you don't need to worry about converting your Canadian dollars and just buy the ETF in Canadian dollars. Now, don't get me wrong, I'm not saying here never invest in US denominated stocks. I just want you to be aware of the consequences of doing each. On the other hand, there's an argument to be made that buying the US version, the VOO, can be cheaper than buying the VFV. While the VOO's MER is 0.03%, VFV's MER is higher at 0.09%. One reason being that the VFV is a wrapper of the VOO and therefore more costly. Although in the larger context, the VFV's MER is still super low and the difference is really small if you ask me, unless if you hold millions of dollars. Personally, I stick to Canadian dollar denominated ETFs if available, simply because I usually buy frequent smaller amounts so I can avoid paying a lot in currency conversion fees. And now the seventh thing, the one that ties everything together, is something that can result in your money growing at a very different rate. The account you hold your stocks and or ETFs in matters just as much as what you put inside it. And that's the decision to invest in non-registered versus registered accounts. There are many different kinds of registered accounts, but just to illustrate the basic concept, I'll only talk about TFSA and RSP here. In the TFSA, the tax-free savings account, you contribute after-tax dollars. and all growth and withdrawals are completely tax-free. It's more flexible as you can withdraw anytime without incurring additional taxes. For most people starting out, especially if they're in a lower income bracket, the TFSA can be a great choice. Now in the RRSP, Registered Retirement Savings Plan, contributions are tax deductible, meaning that they reduce your taxable income today. Growth is sheltered inside the account, but once you withdraw the money, usually in retirement, you will need to pay taxes on it. And the higher your income is right now, the more powerful that upfront deduction is. And you can easily open either of these accounts on most investment platforms, for example on Wealthsimple I mentioned earlier. You just sign up, then open either TFSA, RSP, or other registered accounts in a few clicks, then deposit money into it and start buying stocks, ETFs, or other investments. Both the TFSA and RSP have huge tax benefits. Now compare that to non-registered accounts where no special tax treatment apply. All capital gains, dividends, and interests are fully taxable. Personally, I try to max out my TFSA and RSP accounts first before I invest in non-registered accounts. And I have a full video on TFSA versus RSP decisions linked down below, which goes into a lot more detail. So guys, index ETFs are a great foundation over individual stocks, especially for beginners. Watch the fees. They compound against you just like returns compound for you. Long-term beats day trading in both results and lifestyle. Start investing as soon as possible. Don't try to time the market and wait for the perfect moment. Keep emergency money out of the market. Check the currency conversion before you buy, and use the right registered account. Now, if you're not sure which ETFs to actually put into those accounts, you can join me in this video next where I cover some options. See you there.